Hello, everyone, and good evening. Thank you for joining us at Mirae Asset Mutual Fund. So, in the last 7 months or so, the markets have been quite, showing strength and being resilient. And, while market euphoria is quite notable, there's also a little volatility. So, what should, an investor be looking at in, the times of market euphoria, but as well as volatility? So, to know more on it, to talk more on it, we have with us today Mr. Harshad Borawake. Mr. Harshad is head of research and fund manager at Mirae Asset Mutual Fund. Mr. Harshad has an overall experience of over 18 years across industries like financials, oil and gas, logistics, and aviation. In his current role, he manages Mirae Asset Equity Savings Fund, Mirae Asset Aggressive Hybrid Fund, and Mirae Asset Balanced Advantage Fund, as well as Mirae Asset Multi-Asset Allocation Fund. Welcome, Harshad. So,
Yeah, hi. Thank you, Tanya.
just a Okay. How do I do that? Apologies for a little delay. So yeah, kick starting into it. Let's understand that, what are a few expectations of investors? What are some expectations that investors have in terms of, returns, risk, and experience? So for returns, investors expect that, there's reasonable performance. The post-tax returns are, able to beat inflation. The returns are good for both, medium and long term, and it as well as it beats inflation. In terms of risk, what are a few investor expectations that are there is that, that it does not fall as much as, the pure equity indices could fall. The allocation changes in a timely manner. The final return is sort of a risk adjusted return that, the investor receives. And what experience do the investors want is, that, there are no sleepless nights. There is adequate recovery and timely recovery in case there is a drawdown, as well as, the category or the fund that they are invested in, that, that sort of helps them to achieve their goals. So this is what, the broader experience in terms of investment experience, risk and returns that an investor aims for, that an investor expects. So now coming to the year 2024, globally, 67% of the GDP is poised to go for elections, including India. So we thought, let us look at a few data points. So one of the indicators called volatility index in India, if we see it across election time periods, right from 2009, 2014, and 2019, what we observed is that, the volatility is very heightened 6 months before the election until the rundown to election. There's a lot of volatility in the markets. There's up movements and down movements in the market pretty on a very regular basis. And post the elections, sort of happens, and post the election happens, that heightened volatility sort of, it has a slow death sort of a thing that can be also seen on the left hand side chart of, VIX index, which is the volatility index, and similarly can be said for a broader market index. In this case, we have taken Nifty 50 index that, before elections across time frames, right from 2004 until 2019, the volatility that the market goes through, the upward and downward movement the market goes through just before the elections, due to the anticipation and, the all the media coverage and everything, it's just a lot. So at this time, there is a very general question, very obvious question that a few investors have, that, what do we do at the time of, such heightened volatility? At the same time, it's in 2024 that, the markets are also looking at multiple highs, at some points in time. So while the market sentiment is strong, it's high, but there's also relatively added volatility. So at this time, what we as a fund house look at is that, if one wants to enter with fresh money, or, one wants to sort of look at a category that could, or a fund that could, help them in navigating such market volatility and elevated levels, that could be equity savings fund. So over to you, Harshad, on this, to know more on this and take us through the whole category and fund.
Sure. Yeah. Thanks, Tanya. I think, yeah, clearly, as you mentioned, one is, there are investor expectations. Clearly, they want volatility to be lower, risk to be lower, at the same time, higher, decent returns. And further, as you said rightly, at the current junction, I think a lot of, macro front news flow are going or expected to happen over the next, few months or quarters. So I think in this context, we do believe that, hybrid funds and within that, equity savings do, a lot of sense. So what is equity savings fund? Just to recap, while many of you would already know, but equity savings fund, is nothing but it's a part of a hybrid category, which is as per the SEBI categorization. Equity savings fund essentially, invests into three asset classes. One is equity, second is arbitrage, and third is fixed income. From the taxation point of view, it is a equity taxation for this fund. So to that extent, at any point in time, we need to keep 65% either in terms of cash equity or in terms of arbitrage. I will come to later, how it really works for this fund. So what equity does? Equity essentially helps an investor. One, obviously, it gives an entry into equity as asset class, which we do believe that over the long period, equity as asset class is a good wealth creation asset class. It basically helps in contributing, better returns from the portfolio point of view. Arbitrage, on the other hand, it is essentially a fully hedged positions which we have on the arbitrage front. So it essentially tries to take benefit of the mispricing opportunities which are there in between current price and the future prices. And lastly, debt is nothing but it gives a downside protection in terms of whenever there's a market volatility, and it kind of gives a visibility of at least some basic returns from the portfolio point of view. So now let's look at what is as we move to the next slide. So let's look at how our Mirae Asset Equity Savings Fund, how we go about managing our fund. So this fund as of now is slightly more than 1,000 crore kind of AUM. This was launched back in December 2018. Has completed more than 5.5 years now. So as you know, the fund will have again three asset classes essentially. One is again, just for the sake of repetition, equity, arbitrage, and fixed income. So just to set a context, why it is important to have asset allocation. So for example, if you go recently in 2023, so there Nifty 50, which is a pure equity index, let's say that gave return anywhere between 25 to 27%. On the other hand, if you look at Nifty short duration index, which is a debt index, that gave return of roughly around 7%. Arbitrage index again gave a return of around 8%. So we are talking of three asset classes with one upwards of 25% return, other between 7 to 8% kind of return. So if you look at our equity savings fund, essentially we have largely 1/3 proportion in each asset class. So for example, on the equity side, we have historically been keeping equity percentage anywhere between 40% plus or minus 5%. Equity plus arbitrage put together has to be 65%. So for example, if our cash equity position is 40%, then the 65 minus 40, which is 25%, is arbitrage position for us, and the remaining 35% is a debt portion. So this fund is managed by including me. We have other fund managers, Brijesh and Bharti, and on the debt portion, it is managed by Mr. Mahindra Jatu, who is a debt CIO. Yeah. Now, given that there is a decent time period which has passed since the launch, so let's look at how the fund has behaved. While this all is in the public domain, but just for your reference. So, for example, 100 rupees, if you would have invested at the inception in the fund, so now that 100 rupees is roughly around 180 rupees, over the last, since inception. If you were to compare that with pure equity, let's say Nifty 50. So that is roughly around 210 rupees. So obviously, given that equity portion is anywhere less around 40% plus or minus 5, the returns will obviously be slightly lower than the pure equity fund. But nevertheless, I think it has a decent history since inception. I think the most important thing for hybrid category or equity savings category per se is how does it behave when the markets are volatile, when the markets go down. So there I think it's important to look at how the fund is, the drawdown analysis, what people typically call. So here if you look at the bottom chart, so the orange line is a fund performance, while the blue line is BSE Sensex TRM. So as you can see, whenever the markets went down, or let's say Sensex went down, I think this fund has again given a decent downside protection, or I would say lower drawdown vis-a-vis the broader indices. I think this is what the real purpose, of this equity savings category is. One, it obviously gives you exposure to the equity, but more importantly, when there is a volatility in broader market, it gives a downside protection. Yeah. So as we move ahead, so this is our historical. If you look at orange line, this is our historical asset allocation. And we try to do some analysis vis-a-vis the peers in the category. The light blue line at the bottom is the minimum equity allocation for across the funds which are there in the category, and the top dark line is at the highest level. What is the percentage allocation to the net equity? So we were somewhere in between, as you can see, hovering at around 40%. We went as low as 30. At the higher level, we were at around 45% or so. Currently, we are slightly lower than 40%, which I'll come to in a minute. On the right hand side, if you can see extreme on the shaded area, so there is some drop which has happened on the peer side, where the top percentage has come down. It is largely coincided with change in the taxation which happened for the debt funds, where they no more can take indexation benefits. So to that extent, some funds which were using net equity at higher percentage, they have come down. But for now, we are keeping our strategy largely similar to our historical averages. So let's look at what has really worked for us. This is more recent, last let's say 1 or 2 years. Typically, first let's start with the stock concentration on the right hand side. So there is a decent concentration, I would say, in our portfolios, while the number of stocks could be higher. But in terms of, let's say, top 10 names or top 20 names, so roughly 60% of the percentage allocation within the portfolio is to the top 20 names. So to that extent, when we pick or choose the stocks, it's more of a top-down and bottom-up approach. So to that extent, wherever we have conviction in any names, we do allocate higher weightage towards that, which is already reflected, in the stock concentration. Secondly, I think if you look at the portfolio, the way we build the portfolio, the way we select the stocks, so essential approach is the BMV approach, what we call is, one is focus on business, which means the profitability should be, let's say ROE is upwards of 12% post-tax. Balance sheet should be, in a much better shape. Profitability should be better. Second is management, where I think we do give a lot of importance to the quality of management, corporate governance. And third is valuation. On the valuation, while it is good to talk on a relative basis like PE or PB, but to the extent possible, we do DCF based valuation. And as long as the value which we determine, is more than the underlying stock price or the underlying value, then the stock can be, part of a portfolio. Depending on that, it's a matrix of, what is the earnings growth which is expected vis-a-vis what is the valuation it is trading at. While essentially we are growth investors, but we will not buy stock at any price. Our philosophy is largely growth up to a reasonable price, or GAR, as they call. So as you can see, these are some of the sectors, wherever we have comfort in the earnings growth, or wherever we have comfort on the valuation. So there are overweight and underweight positions. I will not dwell more into that, but you can refer it later, as you look. Yeah. So, earlier we saw, the fund performance over the years as well as the drawdown. So, other thing, essential, important thing also to look at is, up capture ratio. So, while on the risk return metrics, on the risk side, what we look at is the standard deviation. So, there I think the fund has done well, but more importantly, on the up capture ratio, the other way is also important when the markets move up. How much fund does participate in the up move. So there also, I think, given the portfolio, what we have, I think there is a decent up capture which we have witnessed over the years in the fund. Yeah, so the return of a fund, as I said, is essentially driven by two factors. One is the how is the asset allocation between the three asset classes, how much we allocate to cash equity, how much to arbitrage, and how much to fixed income. And after that, the second part is how is the portfolio selection or stock selection within the each asset class. So here a range, if you look at, we can go equity right from 20% to 45%. Fixed income can be between 10% or 35%, or arbitrage can be between 20% or 70%. So all these things put together will essentially determine the return. So while point to point, we believe is not a right way to look at it, but if you look on a rolling return basis, how the experience has been, so the percentage time, let's say the fund has delivered positive returns on a 2-year rolling return basis is, 100%. So to that extent, obviously it's mathematical given that 30-35% of it is, debt, and 20 to 40% could be arbitrage. And if you also look at percentage of times the returns which were in double digits, so I think it is also quite decent. But I think essentially just to repeat, it is not only about allocation between the three asset classes, but also what we buy within these three asset classes. So way forward, again, in the current context, as you know, markets have done well over the last 1.5, 2 years. Within that, mid cap and small cap has done much better than the large cap. In equity savings fund, given the investor profile, typically, we would say conservative or the first time coming to the equity markets. So to that extent, our philosophy has been to have a large cap bias portfolio on the equity front. The focus is more on the wherever we have comfort on the earnings growth and valuation. So within that, I think we have identified few sectors where we believe valuations are quite reasonable despite the run up which has happened. Within that, I think large cap we do believe makes a lot of sense. One, obviously we had our own strategy, but of late, given the comfort on the valuation, we have slightly increased our allocation towards the large cap. Going forward, I think typically, who should invest? Somebody, with a short to medium term kind of time frame. Somebody who is, comfortable with equity taxation from the taxation point of view. Plus, somebody who doesn't want to do asset allocation on his front, but coming first time, to the equity as asset class. So for them, we do believe equity savings fund, it do make a lot of sense, even in the current market context. So yeah, what we'll do, let's take a pause here, and if anyone has questions, we can. Yeah, yeah. Sorry. So last slide, I think it's more about our various offerings within the hybrid funds. So essentially, we have four funds in the hybrid category. On the extreme left bottom, which you can see is equity savings, where you have the lowest equity percentage, which is 40% plus or minus 5%. On the other extreme, we have aggressive hybrid fund, which is Mirae Asset Aggressive Hybrid Fund, where equity percentage can be 72% plus or minus 5. And within these two, you have dynamic asset allocation funds, which is balance advantage and multi-asset. Balance advantage again is driven by the model driven fund. So there, as the model suggests, the equity allocation is done. On the multi-asset, I think the difference between the balance advantage and multi-asset is that multi-asset has commodity as a new angle, and we also have an option to invest into either REITs or foreign equities. Commodity essentially can either be gold or silver primarily. for us. So that's largely the positioning. But as I said, equity savings is on the extreme conservative side with 40% plus or minus 5% equity.
Sure. Thank you, Harshad, for the insightful details on the fund and the category. We'll pause for a moment and see what questions we have. So, viewers joining us from other platforms also, you can always put your questions in the comment section. So, Harshad, one of the most asked question is that, why is the equity savings category right in this current macroeconomic situation wherein, the markets are also going on an upwards trend. And, particularly in comparison, say like a BAF for an investor, who wants to have adequate equity exposure, but also would want a fund which, sort of dynamically manages equity. So in comparison to maybe balance advantage category, why do you feel that equity savings category is right in this current backdrop?
Sure. So I think essentially, the difference between balance advantage and equity savings, I think is clearly the difference is when you buy an equity savings fund, you are largely clear, in terms of what your asset allocation towards the equity could be. It can be, as low as let's say 35% for us or 45%. That's the band, 35 to 45, within which, we'll have equity at any given point in time. But come to balance advantage, the name it's a dynamic asset allocation. So to that extent, it will depending on the market valuations. So we can go as low as 30%, or we can also go as low as 80%. At some point in time, balance advantage may also work like equity savings. At some point in time, it may also look like aggressive hybrid. So to that extent, it's quite dynamic. So as an investor, who is not comfortable to not know what my asset allocation towards the equity could be. So for them, it doesn't make sense to go to balance advantage, and they are fine with aggressive depending on their risk appetite. They can go with equity savings or aggressive hybrid. But on the other end, balance advantage, it's up to the fund manager and our own model, underlying model, which will decide the percentage allocation. So that's the only difference. So when somebody invests in equity savings, he clearly knows, what is the equity percentage he would have.
Right, right. So another question, an interesting question is that, under what scenario would the net equity levels go below the historical net equity levels? This is pertaining to our fund, I believe. If you could share some insights on the same.
Sure. So we have, we have our underlying framework to decide, what percentage equity should be. So mind you, the be it fund manager as I or anybody, as a human being, typically when markets, let's say move at a higher level or go down sharply, so that is a time period where emotions play a lot of role. So to that extent, we want to do away from emotions. So we have created our own internal framework in terms of what the equity percentage should be. So essentially, it consists of earnings growth, which is forward earnings and previous earnings, and we kind of take a trailing plus forward PE. Then there is also the importance given to the balance sheet through a book value methodology. So all these combinations put together and the valuations vis-a-vis the historical averages. So if if it is plus one standard deviation, plus two standard deviation, then we might cut down the equity. If it is minus one or minus two, we will add it. Can it go below 35? Yeah, it may go. For that, the underlying framework should suggest that it should go beyond plus two or plus 2.5 standard deviation. In that scenario, if the valuations are much more higher vis-a-vis, historical averages, we can do that.
Sure. So another question is that, can one consider equity savings funds instead of, say, a direct bond exposure, especially, when currently the interest rate cycle is at a pause and interest rates are quite elevated?
So I think, I think the question is twofold. One is on the bond side, while I'm not expert on that, but what I understand is the general view in the market is that interest rates over the next 12 to 18 months will go down. So to that extent, you would make money on the bond fund. But I think that is also valid for our own, bond portfolio, which is part of the equity savings fund. So that's point number one. It's not that, you're going to miss on that, price movement which could happen in future on the bond side. Secondly, I think the most important, which I believe, is the taxation front. On the bond front, you basically will have a marginal tax rate, but where an equity savings fund, you will have equity taxation. That's point number two. And point number three, I think most importantly, is that equity savings fund also gives an option to, participate into the equity upside. So if you look at India's story for the next 3 to 5 years or 3 to 7 years, then we do believe that, equity as asset class should, perform well. So here I think it's not that you are having like 60-70% equity. The equity is still, let's say between 30 to 40%. You have option to capture, the bond upside. So I think it's a win-win situation. You kind of get best of both the worlds, I would say, in equity savings.
Okay, sure. So another question is that, with the current market levels, is it good to invest lump sum in the fund, or one should look at investing in a staggered manner?
So I think any hybrid fund, according to me, one can invest, lump sum manner. Unlike, if you were to ask me, pure equity fund, there I might say, there is an election event which is happening. You might want to stagger it over 3 months or something like that. But in the hybrid category, given that, fund manager also on their own will do some asset allocation depending on the market movements. So I think one need not worry too much when, one invests into the hybrid category.
Sure. So another question is a little broad-based, but if you could throw some light on the current valuations in the equity market.
Sure, I think clearly if you think from a traditional way of 1 year forward valuation and compare it with, let's say, last 10-12 year average. So on a 1 year basis, clearly markets are not cheap. That I would agree. But I think the way we look at it, is the earnings growth. If I had to look from the next 2 years, so let's say 23 to 26 or 24 to 26 earnings growth. So earnings growth is trending roughly around 17 to 18% for Nifty 50 as an index. If you compare that 2 quarters down the line, markets will roll one year forward again from the earnings point of view. Suddenly, then markets will again start looking reasonable. So one can't really time, in terms of, now markets are overvalued, so let me get out and come back. So timing is very difficult. What I believe, or what we believe, is that, in the interim, maybe for a quarter or so, there could be some time correction which could happen. But as long as, there is underlying growth which is happening in the India corporate, let's say top 200, top 300 companies, I think there is decent money to be made over the medium to long term, and not really, focus on timing, the markets.
Sure. So last question for the webinar. So while we understand in equity the underlying instruments is stocks on the net equity side. In the debt it's corporate bonds and other debt instruments. A few investors have a question that in the arbitrage, what is it that is the underlying instruments? If you could throw some light in detail on the arbitrage part of the fund.
Sure. So arbitrage, essentially, for all our hybrid funds, is essentially a fully hedged position. To that extent, obviously, underlying is the equity. So what we try to do, or what the arbitrage fund manager tries to do, is try to take advantage between the current price, which is in the market, and let's say, 1 month down the line, whatever the expiry date is. If there is a timing, because of timing difference, there is some price arbitrage which is available. We try to capture that. It has nothing to do with, it's neither, it's not a pure long only or pure short kind of position. So whenever we enter into a contract in arbitrage, the returns are fixed, when we are going to get out of it. So there is no risk per se. There is a almost nil risk, I would say, from the arbitrage position point of view. Just trying to take a advantage of timing difference from the price point of view.
Sure.
If you look at, as I said in my initial remarks, so let's say 2023, I think the arbitrage index, which we have, that is roughly given 7.5% kind of return, which is slightly similar to debt kind of number.
Right. So one can, safely conclude that amid this volatility, even though the levels are heightened or elevated, the arbitrage plus debt portion sort of provides you some sort of stability, and the equity portion is your long-term wealth creation component,
Definitely.
right? So, with that, any concluding marks you have, Harshad?
No, I think given that I think right time you chose this topic of equity savings, given the current market conditions. So to that extent, as I said, many people have questions like, as let's for the sake of repetition, lump sum or staggered. So to that extent, I think this is one category where you're not taking, too much risk, 30 to 40% equity. One can go for a lump sum investment, and over the period, you would, get decent risk-adjusted returns.
Sure. Thank you so much, Harshit, for sharing with us your insights on, equity savings fund and the category. And thank you to all viewers for joining us across platforms. For more updates, you can always follow us on our social media handles. You can follow Mirae Asset Mutual Fund across social media. So, thank you so much for tuning in.
Thank you all. Thank you.